Let me ask you something. What if becoming wealthy didn't require being a Wall Street genius? What if you didn't need to pick the next apple? What if you didn't need thousands of dollars? What if you didn't need to stare at stock charts all day? What if all it took was this? 100 bucks. That's like eating out a few less times, canceling subscriptions you forgot existed, or skipping a few impulse Target trips. And here's the crazy part, if you invested just $100 every month and stayed consistent, that tiny habit could grow into hundreds of thousands of dollars. Yep, from piggy bank money to real wealth. And today, Porkfolio is going to show you exactly how that works in the simplest way possible. Okay, first, what even is the S&P 500? Because it sounds like a robot name. Here is a super simple explanation. Imagine you walk into the world's biggest shopping mall. Inside are hundreds of giant companies: Apple, Amazon, Microsoft, Google, Costco, Nvidia, McDonald's. The S&P 500 is basically a basket holding 500 of America's biggest companies. So instead of saying, should I bet all my money on one company? You're spreading your money across hundreds. And that's why beginners like it, because what if one company has a bad year? Your entire life doesn't explode because you're invested in hundreds, so the impact is small and your journey keeps going. Historically, the S&P 500 has averaged around 10% yearly returns over long periods. However, not every year. Some years are ugly. Some years are amazing. But over time, that's the average people often use. Imagine this like planting a money tree. Every month you give it water. The first month, tiny sprout. Month 6, still kind of tiny. Year 2, okay, something's happening. Year 10, now the tree starts showing off. Because the longer you leave it alone, the faster it grows. This is where rich people get weirdly obsessed with time because of something called compounding. Sounds boring, but actually it's magical. Here's what it means: your money makes money, then that money makes money, and then that money makes money. Think of a snowball, it starts tiny, but as it rolls downhill, it keeps picking up more snow. Then it gets bigger and bigger and bigger. But instead of snow, it's money. You might see a scary formula like this. But forget that. Here's the portfolio explanation. Compounding means your money working for you. Now let's do real numbers. You invest $100 every month. That's it. Over 10 years, you personally put in $12,000. But if the market averaged around 10%, your money could grow to roughly $20,000. So you added 12,000 and the market added around 8,000. That's basically a free used car for doing almost nothing except being patient. Now let's double the time, 20 years. You put in 24,000 total, but your account around $76,000. You only put in 24 grand but got over 50 grand in growth? Exactly, that's the magic. Now it gets ridiculous. 30 years. You invest 36,000 total. That's your actual money, but the account could grow to around $200,000 plus. Hold up, you put in 36 grand and somehow got over 160,000 in growth? Yep, that's compounding working its magic. Now, the big one, 40 years, still just $100 a month. That's it. You personally contributed $48,000, not millions, not crazy money, just 48,000 over 4 decades. But your portfolio could grow to roughly $530,000 to $650,000 plus. So the stock market potentially did $500,000 of work. That's insane. Now let's look at the big picture. If two people invest, same amount, same investments, same returns, but one starts 10 years earlier, that earlier person can end up way ahead because time is doing the heavy lifting. Not genius, not luck, but time. Now, I know what some people are thinking. Yeah, but what if the stock market crashes? Which is a fair question. Because markets do crash. It happens. Stocks go down, headlines get dramatic, people panic. And yes, it can get scary. But as Warren Buffett famously said, the stock market is a device for transferring money from the impatient to the patient. Translation: people who panic and quit often lose, but those who stay consistent give their money time to grow. Patience isn't just a virtue, it's a superpower. Because when you zoom out historically, the market has recovered from crashes over long periods. That's why long term investors focus on consistency, patience, time, and not trying to get rich by next Tuesday. And no, this is not the same as gambling on random meme stocks. You're not betting your piggy bank on some random company selling rocket powered bacon. You're investing in huge businesses people use every day: Apple, Amazon, Google, Microsoft, Costco, etc. These companies have real products, real customers, real profits, real staying power. That's a huge difference. If someone wanted to start, the basic roadmap looks like this. Step 1: open a brokerage account. Think of it like a shopping account, but for investments. Examples include Vanguard, Fidelity, and Charles Schwab. Step 2: choose an S&P 500 index fund. That's just the basket. Step 3: automate it. Set $100 monthly. Then stop overthinking because consistency beats motivation. Here's the truth: $100 a month probably won't get you rich next week or next month, maybe not even next year. But over decades, tiny habits become life changing money. So, the biggest investing mistake? It's starting too late. Because in investing, time is your richest friend. And Porkfolio approves.